Currency wars, the erosion of dollar hegemony, introduction, monetary power as geopolitical power. The international monetary system has always been inseparable from geopolitical hierarchy. Currency dominance is not merely an economic outcome but a manifestation of structural power, institutional trust, military projection capability, and global dependence networks. The dominance of the United States dollar represents one of the most significant power consolidations in modern history, allowing the United States to externalize domestic economic pressure and internalize global financial advantages. The contemporary discussion of currency wars reflects growing tensions within the international systems, as rising powers seek to reduce dependency on the dollar, challenge the asymmetry benefits embedded in the dollar-centric architecture of global finance. The concept of dollar hegemony refers not only to widespread usage of the dollar in trade and reserves, but to the systematic privilege that allows the United States to shape global liquidity conditions, influence capital flows, and impose capital and financial constraints on other nations through monetary mechanisms. Currency wars emerge when states deliberately intervene in foreign exchange markets, monetary policy, and financial institutions to weaken competitor currencies or strengthen their own strategic economic positioning. Such wars are fought through military confrontation, but through Such wars are not fought through military confrontation but through interest rate manipulation, capital controls, sanctions, reserve diversification strategies, and alternative payment infrastructure. These mechanisms demonstrate that economic instruments have become primary tools of geopolitical competition in a multipolar world where financial systems serve both as infrastructure and a weapon. Historical foundations of monetary dominance. The evolution of monetary system reveals a persistent pattern in which dominant political powers create currency systems that reinforce their structural advantages. Each monetary system relied on commodities such as silver and gold, whose scarcity provided inherent value stability. Over time, the emergence of fiat currencies shifted trust from physical commodities to sovereign institutions. Central banks became the guarantors of value, stability, and national currencies became instruments of policy intervention and macroeconomic management. The transformation of the dollar into the central reserve currency was institutionalized through the Bretton Woods Agreement following the Second World War. Under this system, currencies were pegged to the dollar, and the dollar itself was convertible into gold at a fixed rate. This arrangement placed the United States at the center of global monetary flows and established structural dependencies on the dollar for international trade and capital accumulation. The Bretton Woods system reinforced American economic dominance by institutionalizing demand for the dollar. Currencies needed dollar reserves to stabilize exchange rate, facilitate trade, and maintain access to international financial markets. Even after the collapse of the gold convertibility system in 1971, the dollar maintained its central role due to the inertia of global financial networks, the depth of U.S. capital markets, and the credibility of American institutions. The continuation of dollar dominance without gold backing demonstrates that hegemonic currencies rely more on geopolitical structure than on intrinsic monetary characteristics. The structural advantages of dollar hegemony. Dollar hegemony generates several structural advantages that allow the United States to operate under different macroeconomic constraints compared to other nations. One of the most significant privileges is the ability to finance persistent current account deficits without facing traditional balance of payments crisis. Because international trade is largely dominated in dollars, foreign governments accumulate dollar reserves to stabilize their own currencies. This process effectively allows the United States to borrow at lower interest rates and sustain higher levels of debt than would otherwise be possible. The dollar's reserve status also enables the United States to export inflation when Federal Reserve expands the monetary supply through quantitative easing or other liquidity measures. The impact is transmitted globally through capital markets. Countries holding large dollar reserves experience shifts in asset prices, exchange rates, and capital flows that they do not directly control. Monetary policy decisions made in Washington, therefore, influence economic conditions in emerging markets, creating asymmetrical dependency relationships. Another advantage lies in the integration of financial markets with the US regulatory and institutional frameworks. Global banks rely on dollar clearing systems and international trade settlements frequently pass through American financial infrastructure. This allows the United States to impose financial sanctions that effectively isolate targeted conditions from global markets. The ability to weaponize financial infrastructure demonstrates that dominance operates as a form of geopolitical leverage rather than a merely medium of exchange. The Triffin Dilemma and systematic instability. The structural tensions embedded within dollar hegemony are captured by the Triffin Dilemma, which argues that a reserve currency issuer must provide global liquidity through persistent deficits. But such deficits eventually undermine confidence in the currency itself. The global demand for dollar requires the United States to supply large quantities of dollar denominated assets, typically through government debt issuance. Over time, increasing debt levels raise concerns about long term stability and purchasing power. This structural contradiction implies that the very mechanism sustaining dollar dominance simultaneously erodes its credibility. As dollar reserves become increasingly concentrated in dollar assets, concerns emerge regarding inflation risks, financial stability, and political instability within the United States. Currencies holding large dollar reserves therefore face strategic incentives to diversify into alternative assets such as gold, euros, or emerging currency systems. The Triffin dilemma highlights the paradox that a global monetary system based on single national currency may become unstable as economic power becomes more geographically distributed. As emerging economies increase their share of global production and trade, the mismatch between a multipolar economic structure and a unipolar monetary system creates systematic tensions that encourage experimentation with alternative arrangements. Quantitative easing and the politicization of monetary policy. The 2008 global crisis intensified debates surrounding the sustainability of dollar dominance. In response to the crisis, the Federal Reserve implemented quantitative easing programs designed to stabilize financial markets and stimulate economic recovery. These policies involve large scale purchase of government bonds and other financial assets, effectively increasing the money supply. While quantitative easing prevented a deflation and stabilized financial institutions, it also generated concerns among foreign governments holding substantial dollar reserves. The expansion of the monetary supply reduced the relative value of existing dollar holdings, creating implicit redistribution effects across countries. Emerging economies argued that US monetary policy imposed external costs on their financial systems, forcing them to manage capital inflows, exchange rate volatility, and asset price inflation. The perception that the United States could unilaterally alter global liquidity conditions reinforced incentives for other countries to reduce dependence on the dollar. Central banks began exploring currency swap agreements, regional reserve pooling mechanisms, and diversification strategies aimed at reducing exposure to dollar denominated assets. These developments illustrate how domestic monetary policy decisions can produce geopolitical consequences in an interconnected financial system. The rise of alternative monetary architectures. Efforts to reduce reliance on the dollar have taken multiple forms, ranging from bilateral trade agreements denominated in local currencies to the development of alternative payment systems that bypass traditional dollar clearing channels. China has promoted the internationalization of the ren- renminbi through currency swap agreements and participation in multilateral financial institutions. Proposals have also been made for expansion of the International Monetary Fund special drawing rights as potential supranational reserve asset. Regional financial institutions such as the Asian Infrastructure Investment Bank and the New Development Bank represents attempt to create parallel financial ecosystem that reduce dependence on Western denominated institutions. Digital currencies issued by central bank introduce additional possibilities for reshaping international payment systems by reducing reliance on traditional correspondent bank networks. Although none of these alternatives currently rival the liquidity depth of dollar markets, their cumulative development suggests a gradual transition towards a multi-currency reserve system. Such a system would reduce the concentration of monetary power and distribute adjustment burdens more evenly across major economies. Geopolitical competition and the dollar yuan rivalry. The strategic rivalry between the United States and China illustrates how currency competition intersects with broader geopolitical competition. China's accumulation of large dollar reserves reflects both participation and vulnerability of the dollar based system. Maintaining the value of these reserves is essential for domestic financial stability and social cohesion. China has gradually expanded the international use of the renminbi through trade settlement agreements, offshore clearing centers, and the inclusion of IMF's special drawing rights basket. These measures represent incremental steps towards reducing dependence on the dollar rather than an immediate attempt to replace it. The coexistence of cooperation and competition characterizes the evolving relationship between major economic powers. While global trade benefits from stable monetary arrangements, strategic incentives encourage diversification and institutional experimentation. Currency competition therefore operates as both a stabilizing and destabilizing force within the international system. The role of energy markets in sustaining dollar demand. The price of oil and other commodities in dollars reinforces structural demand for the currency. Energy importing countries must hold dollar reserves to purchase oil, creating a persistent global need for dollar liquidity. This arrangement strengthens dollar's role as a dominant medium of exchange in international trade. Changes in energy market include shift towards renewable energy sources and diversification of commodity pricing mechanisms may influence future demand for dollar reserves. If major commodity exporters begin accepting alternative currencies, the network effects sustaining dollar dominance could weaken. However, such transitions are likely to occur gradually due to high transaction costs associated with restructuring global payment systems. Internal structural weakness within the dollar system. The sustainability of dollar dominance depends not on external competition but on domestic economic stability within the United States. Persistent fiscal deficit, rising public demand levels, and political polarization contribute to concerns regarding long term monetary credibility. Critics argue that excessive reliance on debt financing may undermine confidence in the dollar's purchasing power. Domestic institutional credibility remains a high determinant of reserve currency status. Investors demand not only an economic stability but also legal predictability, transparent governance, deep financial markets. Any deterioration in these institutional characteristics could accelerate diversification away from dollar assets. Prospects for a multipolar monetary system. The gradual erosion of a dollar hegemony doesn't necessarily imply abrupt displacement by a single alternative currency. Instead, the international monetary system may evolve towards a multipolar structure in which several currencies share reserve functions such as arrangement. Such an arrangement could reduce systematic vulnerability associated with dependence on a single national currency. A multi-currency system may distribute adjustment pressure more evenly across major economies, reducing the likelihood of destabilizing capital flow reversals. However, coordination challenges may increase and as multiple reserve issuers pursue independent monetary policies. Institutional reforms may therefore be necessary to ensure stability within a more fragmented monetary architecture. Conclusion. Currency as an instrument of strategic power. Currency wars reflect the transformation of economic policy into a central arena of geopolitical competition. The dominance of the dollar has provided the United States with significant structural advantages, enabling it to shape global liquidity conditions and influence international economic outcomes. However, the convergence of internal fiscal pressures, external strategic competition, and technological innovation is gradually altering the balance of monetary power. The erosion of dollar hegemony doesn't represent the immediate collapse of the existing system, but rather the emergence of a more complex and congested monetary order. Future developments will depend on the interaction between institutional credibility, geopolitical strategy, and technological innovation in the financial systems. The evolution of international monetary system, therefore, remains inseparable from the broader dynamics of a global power distribution.